Hello, fellow old dogs. I just wanted to mention our great sponsor for today's show, Equity and Help. Yeah, they've been on before, but we love them. One of the reasons why is I remember living in Haiti. One of the things we did was to help people find housing. And I love the idea of helping people in the U.S. get into a home who might not normally be able to do so. And you see an 8 to 12 return on investment, which doesn't hurt too much either. Well, check them out at equityandhelp.com. That's equityandhelp.com.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manassero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manassero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, shame on you. Go to iTunes or Apple Podcast, type in Old Dogs, spelled D-A-W-G-S, find our podcast, and subscribe. Well, we have a great guest for you today. This young man is just Mr. I don't know, it's a Mr. Analyzing or Mr. Underwriter here for multifamily. And he has dug really deep into every nuance and every aspect of analyzing multifamily specifically. And I think this is going to be great because I think there's going to be some things that you may not even have thought about in terms of this type of analysis. I know there's many here that listen that may not be in multifamily at this time, but I think a lot of the principles are something that even in small multifamilies, duplexes and quads and so forth would be applicable. And then there are those that are listening that are passive investors that will, I think, gain a lot from this show. So the person I'm talking about is Rob Beardsley, and he oversees acquisitions and capital markets for Lone Star Capital and has acquired over $100 million of multifamily real estate. He has evaluated thousands of opportunities using proprietary underwriting models and published the #1 book on multifamily underwriting. And it's called The Definitive Guide to Underwriting Multifamily Acquisitions. He has written over 50 articles about underwriting, deal structures, and capital markets, and hosts the Capital Spotlight podcast, which is focused on interviewing institutional investors. That's going to be an interesting show. That's great. Well, Rob, welcome to the Old Dogs REI Network.
So glad to be here, and thank you for that introduction.
Oh, well, it's my pleasure. You're not exactly an old dog here. You look like you're actually pretty young, but I'm sure you're older than you probably look, but you definitely speak as a person with experience in terms of, reading, some of your articles, as well as looking at videos and so forth where you're explaining the underwriting process. I think there's a lot of meat here, and you definitely know your topic. But before we jump into it, which I'm real excited about, because multifamily analysis is a critical part of success for anybody that's either a passive or active investor in multifamily properties. And so I'm really stoked about it. But before we get started, I really wanted to hear just about you and where you're from and how you got into this space.
Absolutely. So I grew up in Silicon Valley in Northern California, and funny enough, I kind of got two major influences. Since I grew up in Silicon Valley, I had a major tech influence. There was a lot of people around me that were very successful in tech, and everyone felt that the best way to be successful in life was to be a part of a tech startup or join one of the major tech firms. And my parents included. They wanted that for me as well. However, my parents themselves, they were actually running a residential real estate brokerage firm in Silicon Valley, buying and selling luxury homes for their clients, and then doing some flips and development on the side as well, all on the residential side. So I had their early on real estate exposure and experience, as well as the tech influence of the zeitgeist. And so I did end up going to school for computer science and was pursuing that tech route, but along the way I did circle back to real estate just because I was in a practical search for cash flow, for wealth accumulation, wealth building, and I just felt compelled that not necessarily residential real estate, but real estate itself, buy and hold, was the most superior way to go about actualizing those goals that I had of long-term wealth creation, not just, quickly making money or and focusing on transactions. And that's the juxtaposition of what I saw my parents doing, which they were, as they told me, and based on my observations, driving themselves crazy. And I hated seeing them work so hard and always working on the next deal and being very transaction driven. What that did is it brought them an income, but it didn't really build them assets or build them a base to build wealth with. And so that was kind of my vision and how I wanted to do things a little bit differently. And that pushed me in the direction of multifamily, which it's not to say that you couldn't do those things in single family, but I just felt that in the multifamily space, it's far more conducive to that long-term wealth building, just because of the scalability, the way that you can run it as a real business, were the things that really attracted me. So, all this was happening while I was actually in school, still studying computer science, and I actually started investing in real estate, started building my company, which is now Lone Star Capital with my business partner, and we've got a property management arm and a growing portfolio. That all started back in school when I was still just learning to figure this out. And of course, as we'll discuss later, one of those things that I had to figure out along the way was underwriting.
Well, definitely. That's especially, well, it depends. How did you get started with Lone Star? Were you buying immediately buying multifamily properties, or were you also doing other types of assets?
Yes. So the start was multifamily. Through the help of my parents, through the help of mentors, I was able to, and also honestly, I would say the best part was just being young and naive and not having kind of these preconceived notions. I was able to tell myself that, hey, I can just jump in and pursue these larger deals, and I can figure it out as I go. I can raise the capital, figure out how to get the team in place to actually manage the process. So that belief in itself was, I would say, one of the most important factors of the success, aside from just having the right people in my corner.
And you talked about having a mentor or somebody that also sort of directed you. Was that something you did before you formed the company, or once you had formed the company?
It was prior to forming the company. I was in that mode, which I highly recommend everyone who's interested in being an active investor, of being in that networking mode, of going to meetups, going to conferences, and joining groups and things like that. Just to find people that you can align with.
That's great. And what was sort of your first purchase in the multifamily space?
So the first property we acquired was actually a little bit larger than a lot larger than what we were comfortable with. It was a 261 unit multifamily property in Houston, Texas. That was pretty rough. It was definitely Class C. It was rougher than what we were really expecting. So we had a lot of surprises and a lot to deal with. And aside from, before we even getting to the opportunity and the asset itself, we had so many obstacles to closing, as many people know, as far as raising capital, qualifying to borrow the debt, and things like that. So we had to make sure to get the right people on the team and build these partnerships in unfortunately a short amount of time to get to the closing finish line.
Wow. Yeah. I mean, that's a big asset. And what was the final sales price?
We purchased the property for $15.4 million, and we raised $4.4 million for the acquisition.
Man, okay, so you had to have some sort of contacts in order to take on that size of a project, and not only that, but I would imagine for the financing, you'd have to have people on your team that definitely had the net worth as well. Yeah,
and so that was, those are some of the struggles that we had. We had plenty of. It was one of the biggest challenges of my life for sure to try to go out and raise the capital. I think everybody has this idea about raising money that it's easier than they think it is. Everyone goes through that process and realizes, oh wow, actually raising money is really hard. And I think, I don't know what your opinion of this is, but I think it's an absolute myth that if you have the right deal, the money will come. Because I've seen it firsthand, and I've seen it happen around me, that if you do have a great deal, it doesn't fund itself. You still have to have the contacts. It starts with trust. It starts with the relationships. And the deal does not sell itself, unfortunately. So that was something that I learned, because I back then believed that. I thought, well, if we find the right deal, we'll just be able to raise the money, and it's not going to be an issue. But I had to pretty much talk to everybody I know and ask people for introductions and give pieces of the pie away to make the deal happen. But I kept telling myself that it doesn't matter if I get squeezed on fees or on ownership. As long as we get the deal done, it'll be the best thing that ever happens to me, and it's as if I'm getting paid to learn. So I was, I kept a good attitude, and I was just, committed and determined to get it done.
Now, how long did it take you to find the property from the time you decided, we're gonna go ahead and purchase a multifamily property?
It was just under 2 years, and during that period of time, it was kind of a process of focus, because at first, when I first started, I was asking my dad where does he think I should look for properties, and he was saying, well, I know the Silicon Valley market, and that's where I'm comfortable, and so that's where you should look. And so I started looking there, and it was just very hard to find deals. And based on the model that I was looking at deals, which was for cash flow, it really didn't exist in the Silicon Valley area. So after looking at over 100 deals there, and finally saying I don't think this is the right fit, we started looking out of state, and we started networking with other people who were also looking out of state. And that's when we started looking at Texas, because Texas is very large market, a lot of opportunities there. The growth is fantastic, and the type of asset that we want to own and operate exists there as well. Large garden style apartment communities, suburban style communities. And so once we started looking in Texas, that's when we were able to really get some more momentum. Obviously have to spend time in the market, driving these properties, touring the properties, understanding the construction, understanding the neighborhoods, and things like that. So once we started focusing on Texas, I think it was about maybe a year to make it happen.
Now, did you have a full-time job at this time?
Well, so I would say the first really up until the first acquisition, I was still in school. So I was in college, keeping up with my computer science degree, and in my off time was building this business, was building the relationships, was trying to teach myself underwriting, teach myself how to build a brand, raising capital, the operations, and so that was the parallel track.
Got it. Wow. Well, you were still in school. That's pretty amazing. And then you're going to have to connect with some people. And while you're in Silicon Valley, so maybe it's a little bit easier, but you had to connect with people that had the kinds of funds that would be able to put into this, make this deal happen. So was that part of sort of your networking? You mentioned you were getting involved with a lot of groups and attending a lot of events.
Yeah, that's right. So I was really pushing in every angle possible, and I can't take all the credit or even half of it. During this time I started building the company with a partner who is older than me, more experience and more contacts, which at that time was the critical component, as you're mentioning, to get that deal done. And so that's what we. So certainly relied on his network, and then also my family's network in Silicon Valley, like you mentioned, was allowed me to have meetings and have warm introductions, which is definitely an advantage. And then lastly, it's the real estate groups, and I think the final strategy that we were actually fairly successful with was bringing on people onto the team who they themselves were experienced, were able to vet a property, understand the business plan, and then be able to go to their networks and bring investors in from their networks as well.
Now, were you building your team before you acquired this property?
I would say yes and no. I'd say during the search for this property, my business partner and we came together, and I think one of the awesome things about the real estate investment business is it's a very deal driven business, so you can essentially date. You don't have to get married and say, all right, we're starting a company together and now we're going to be forever together, right? You could say, oh, well, let's do a deal together, and this joint venture will be the deal, and we could try it out. If we love it, we can keep going. If we hate it, then we just have this one problem child and we'll deal with this one deal, and we don't have to work together. So that was, I think that's a great way to get started. I always tell people to network fast, but to partner slow, or to date and try it out. And so that's what we did. We started working on some deals together, looking at stuff together, getting to know each other. And that was what got my business partner and I comfortable with each other to move forward on a permanent basis.
And did you meet the partner at one of your networking groups or meetups?
Yeah. Actually, we met at a conference.
Great. Now, so the deal, you made it sound like there was some major work to be done on this apartment. What was the vacancy, and what were some of the challenges there?
Yeah. So the challenges were when we were first looking at the property, we were looking at it as if it were near stabilized, that it was kind of in the mid 80s occupancy, and that we were able to buy something that was fairly close to stabilization. But once we got under contract, and as we got actually through takeover, we just saw the occupancy and performance decline. And especially over takeover, we realized that the rent roll was really of poor quality, and the current owner, or the seller rather, was not really interested in holding long term, so they had just packed the rent roll with poor quality tenants and left us to deal with it. And so that's what led to our having a lower occupancy than expected, and then just more turnover, and having to deal with all of that as we're trying to implement our value add of curing deferred maintenance, renovating the exterior, and then updating the interiors to be able to attract and also add washers and dryers into units to be able to attract a family demographic as the tenant base.
Part of your model with this was it was a value add model for the most part, right? I mean, you were looking to go in there, add the kinds of things to attract a higher rent, or were you doing any sort of major construction?
No, I would say it's, aside from the kind of somewhat destabilized takeover, it's a pretty classic value add where, we were spending about, I'd say just under 10,000 per unit in total on the interiors and the exteriors. So I'd say we weren't dealing with major construction or anything like that.
Okay, gotcha. And a C class product?
Yes, 80 C class.
Got it. Now, you had mentioned when you were first started looking for product, you were looking in Silicon Valley area, and you went through 100 plus different multifamily products that were in that area. And in that process, I mean, how did you start analyzing? Did you have any background in looking at these? And were you just sort of, where did you get sort of an idea of what you had to look at to know if it was a good property or not?
Yeah, that's a great question. And I look back on it and think, geez, what was I thinking? How did I think I knew what I was looking at? And so, certainly when I started, I didn't know anything. And so through the process of looking at so many deals, looking at so many financial statements and pro formas, the first step was starting to build my own pro forma, which, prior to recording, we were talking about the underwriting model that I built and that we use, to this day to analyze over 500 properties per year. Starting on that journey of actually building my own model was one of the ways that I, in my opinion, learned so much so quickly, because I kind of had to know how the sausage is made and not just garbage in, garbage out, right? It forced me to understand the financials and how they all connect to create an underwriting model, a pro forma, and then projected returns. And so I would just say through that process of doing it so many times, that's how I started to figure out what the heck I was looking at. And then when you add on to that process of actually going and seeking external feedback, right? I'm not just doing this in a dark room all alone and then not letting anybody look. I was, sharing it with bankers, with potential investors, and so and brokers, and getting their feedback. And so I think having that 360 feedback is also really awesome. And to this day, I'm always really excited and looking forward to opportunities where someone can evaluate our underwriting, our process, our methodology, our business plan. Especially investors, right? If an investor can tear us apart, that's an awesome experience, because we can go back and build better and learn from the experience.
And that, frankly, was one of the things that really attracted me to what you're doing is your underwriting is a significant part of your presentation, and it's almost like just looking at one of your presentations. I mean, that is it's built in, and I think that is, to me, is a really, really strong selling point when you can go in there and you're digging under the numbers there and presenting why you came to the conclusions that you did. And I think a lot of times in a pro forma, you just kind of get a lot of glancing over, and you have to just trust the person. But you actually dig in, I think, and share. It looked like you were just actually sharing your spreadsheet to a certain degree in terms of how you came to the conclusions that you did.
Yeah, I appreciate that. It's definitely a major part of what we do, and I think to some extent there is a little bit of lack of transparency in this business, where some sponsors aren't willing to share their spreadsheet because maybe they feel like they have some sort of secret sauce to control, or they just don't want to open up their methodology or their assumptions up to scrutiny. And I think, I don't feel too strongly about any of this being secret sauce. I think real estate's a pretty simple business. I think we're all just kind of modeling out cash flows. So we're at least an open book. We share our full financial models with our investors, and like you said, on our kind of webinars, whether we're just kind of sharing insights or talking about a specific investment opportunity, we're definitely going under the hood and wanting to share all the assumptions that we're making, so that way investors know what the basis of the investment is. And that kind of also transitions to another thought, which we could talk about, and you mentioned earlier, which is underwriting from the perspective of a passive investor, which I think is far less common, right? Everyone's doing underwriting as they should as sponsors, but I think it's far more rare to see a passive investor who's actually doing some underwriting, which I think is a shame, and it's something that I'm trying to change with the publishing of my book, The Definitive Guide to Underwriting Multifamily Acquisitions. It's definitely not a first step beginner's book, but it is and hopefully simple enough that anybody can kind of pick it up and start working on underwriting and can underwrite their own deal and make a decision for themselves based on their own assumptions about the potential of an opportunity.
Well, and again, I think that's one of the appeals there is that a potential investor could dig in and even use your spreadsheet, which you make available as a tool. So you have to be willing at that point to share all the numbers, which a lot of principals aren't really willing to do. And so I think that's what makes it real appealing as an investor myself. I will go, wow, you're going to let me look under the hood, and not only under the hood, but under the, I mean, to go into the trunk and dig under the chairs, I mean, just to look at everything, and I think that's, that I think is very appealing. And I think your model, is one that you really do cover every aspect, where you can look at, how did you arrive at any given number, whether it's your IRR, or whether or not it's in terms of your construction budget or whatever it is, that it's very, very transparent, but also, very simple, I think, for some passive investors just to be able to take a look at, and they can go as deep as they want, which I think is something any investor would want to do if they're going to put their hard-earned money into a project.
Yeah, I agree, and that's not to say that we don't have investors who just invest with us based on relationship and trust, right? We have plenty of investors who just don't look at anything and they say, I'm in, and we're ready to go, and that's great too. But we definitely want to, and I think our company and what we've done and who we are definitely caters to those investors who are actually wanting to go under the hood, which may sound great, but also it has some downsides, because we do have, we kind of joke like, oh, wouldn't it be nice to just have the investors that just kind of phone it in and then write you a check, but we definitely attract the investors that are sophisticated. They want to run through the numbers. They want to dig into the spreadsheets. They have great questions. So, it might be a little more work, but it makes everyone better in the process. And I think they're also, those types of investors, if I were to guess, would maybe be more understanding through difficult times, because they're aware of the numbers as well. They're not just investing based on a hope. They actually understand the realities of the numbers, and because deals always go through difficult situations, and at those points, a sponsor or principal's favorite investor is definitely a patient and understanding one.
Right. And I think that's, like you said, it's not everybody is like that, especially if they've done deals with you in the past and they have a comfort level. They're not going to nitpick on a lot of things. But early on, there are those folks that just, that are more analytical, that want their questions answered and intelligently too. So, I think that's great that you're willing to take the time. You mentioned you look at like 500 properties a year. Is that right, or did I hear you wrong?
No, that's right. That's the target. That's about right. 10 deals per week.
Wow, that's amazing. Now, do you have a sort of I know your spreadsheet goes into a lot more detail, but do you have sort of a screening out process, things that you look at that you just basically, you don't have to dig deep. You can look at a project and say, okay, here are some of the key areas that I would look at, and if things look, good in that area, then I'll go into the next step.
Yeah, definitely. So there's some deals that originally when first looking at them are kind of on the fence, and then we'll have a quick discussion about it. There's some deals that just come across our desk and say, yep, that just checks the boxes. Let's go and do a full underwriting. And, that's pretty often actually. So I'd say, the universe of deals starts out at maybe 1,000 or something like that. And then we actually do a full underwriting analysis on roughly 500, we'll say. But yeah, so those initial screenings would be focused on median household income, population growth, and kind of the condition of the asset as far as age of the property and whatnot. So we're trying to be more concerned about the vintage of the property and buy newer property or property that's in more renovated condition, or at least the major systems such as plumbing, wiring, and HVAC and things like that. We don't mind classic interiors or some deferred maintenance, but we don't want to have systemic issues associated with older properties. So those are some of the things that we're trying to screen out early on. Also pricing. It's really hard actually to screen out based on pricing, because sometimes a deal comes across your desk and it sounds expensive. Like, $100,000 per unit for this in that area, are you crazy? But then when you actually look at the numbers, it looks okay. And then other times you might hear a deal, actually, $58,000 per unit, that sounds cheap. But then you dig in and it doesn't make sense. So it is hard to screen based on pricing, though we try to a little bit. But yeah, so those I think are the great ones first, because if you're in a median household income area of 20,000, right, the numbers might jump off the page, but at the end of the day, do you want to be in that type of neighborhood? Might be yes, might be no, but that's something that you kind of want to pre-screen for.
Financial freedom doesn't have to be a pipe dream. With investments in real estate, they may be hit or miss, all depending on how the market's looking for the coming years. Now, what if there was a method that included both stability and benefits to hardworking families in need without sacrificing your return? Equity and Help have cracked the code with a proven method that offers steady cash flow while making a difference. Equity and Help locates the properties, fixes the properties up, finds the perfect families to live there, all to ensure that you get the best return while families enjoy their happy new home. That is achieving financial freedom while making a difference. For more information, call your Philanthro Investor consultant from Equity and Help at 844-552-8828 or visit equityandhelp.com/podcast to become a Philanthro Investor. That's equityandhelp.com/podcast. Cap rate's not that important off the top of your head?
Well, the tricky thing about cap rate is you can't really take anyone's cap rate at face value, right? There's very few people in this world who, when they say a cap rate, I actually believe them, right? If they say this is a 4.5% cap rate, and I can say, okay, sounds good, I'll take that as fact. Right? You can't really do that with brokers. I mean, brokers are great, and they know what they're talking about, but it is their business to kind of fluff the numbers, and they see the numbers through just a slightly different angle that we do. So the cap rate's not going to be quite the same. So I think cap rate is definitely important. There's some people out there who say, cap rate is meaningless to me. I buy based on the value add opportunity, and I'm looking at IRR. But I think you definitely have to pay attention to the cap rate. Just unfortunately, it does require us to actually take in the financials and adjust them for our own expenses, adjusting for insurance, property taxes, and things like that before we can come to a cap rate conclusion.
And where are you finding most of your deals? Are they coming directly from brokers? Are you looking for off market? Are you doing any direct mail? Where are you finding most of your good deals?
Yeah, so the vast majority of our deal flow definitely comes from the broker network. So we're not doing super fancy stuff as far as cold calling owners or doing direct mailers. I wish we were doing some more exciting things like that, but the vast majority of our deal flow is coming through brokers. However, with that being said, we have yet to acquire a property through a traditional marketing process, meaning it gets listed, and then there's a call for offer date, then there's a best and final process with the top buyers, interviews, and then a buyer is selected. Unfortunately, we have never successfully gone through that entire process. All the deals that we've purchased to date have been either off market, so they've been, limited. There's been a limited marketing process by a broker who's shown it to a handful of folks, or it was a stale marketing process where it did hit the market, but it didn't transact, so kind of languished. Or it maybe fell out of contract, and then the broker made a couple calls to see if they could piece the deal back together. So those have been the ways that we've found success, and it's it can be frustrating because we're left kind of just waiting for an opportunity to come, and all the while we're still continuing to look at, like, as tons of deals every month, and without really too much of a chance of getting it and making it happen. But I'm still very interested in continuing to do that because of all the intelligence that it gives us by looking at all these deals. And also we're getting reps with the brokers. They see that we're active, and that way when an opportunity that really makes sense for us comes, they know who to call.
Talk about the market too. You're obviously very vested in Texas. Are you going to stick in that area, or and how important is sort of the market analysis in your underwriting?
Yeah, for now, Texas is our main focus, and we are going to continue to grow there because I think it's much easier to add on acquisitions in a market where you already own than try to start fresh, just based on the relationships and the market knowledge that we've already accrued up to this point. But certainly I see us in the future expanding out and wanting to add additional markets and additional strategies. So that's something I'm very much looking forward to. Yeah, so that's one of the interesting things about underwriting is there are inputs or things that matter to your analysis that aren't really readily convertible into numbers, right? For example, I always use the simple example of the school district, right? Is the school district an A, B, C, D? How do you actually just plug that into your model? It's not so straightforward, right? So similarly with median household income or population growth, these are percentages that don't directly impact your underwriting, but still are really relevant and need to be factored in somehow. So the quality of the market is definitely very important, and the way that it really shows up in the numbers is by the rent growth assumptions that you make, as well as the exit cap rate, which for those that aren't familiar, the exit cap rate essentially determines the price at which you project to sell the property for. And so if you're in a better area, in a group more in a area that's growing more, then you'd have the confidence to project a more aggressive exit cap rate where you would potentially yield a higher price. And conversely, if you're in kind of a worse area, you might want to use a more conservative exit cap rate to reflect that reality. So those are some of the ways that we factor in the market.
And are you working on, are your models pretty much the same, a 3-year, 5-year, 7-year hold, something like that? And, or do you sometimes buy for the long term?
The strategy definitely varies by deal, but I try to keep the underwriting analysis as apples to apples as possible across deals, because it makes it easier to analyze and compare properties, right? If I'm looking at one deal on a 6-year hold and another deal on a 4-year hold, one has a refi, it starts to make it difficult to actually say, well, this is a good deal, this is a bad deal because of X, Y, and Z. But if we can try to keep them all the same, then it's much easier to do a relative analysis and say, okay, well, we've underwritten 100 deals in the last couple months, and the top 5 deals look like this, and then that's what we need to chase after. So for us, the way that we try to standardize is we'll typically do a 5-year hold for properties that we're financing with permanent debt, typically agency Fannie Mae and Freddie Mac debt. So that's long-term conservative debt. It's a great product for buy and hold and a cash flowing investment. Then on the flip side, if we're buying a more deeper value add property that requires a bridge loan because it's unstabilized, the occupancy is low, or due to the large construction budget, we might need to have a bridge loan that will finance the capex. that on those types of business plans, we'll use a 3-year hold. So we try to stick with just two holds: 3-year hold for the kind of buy it, fix it, sell it model, and then a 5-year hold for the more light value add core plus model. And so, like I said, that allows us to compare apples to apples better.
That's great. You looked at a lot of other models in terms of underwriting, and that was interesting to me, is that you had an opportunity to sort of look at a broad section of what people were doing, kind of picking and choosing what you liked, what you didn't like, and adapting and for your own needs. What would you say your model has in it that maybe the other ones don't have, or maybe you emphasize more than the majority of those other models out there?
Yeah, sure. So there's everyone has their own model, and everyone's going to say their own model is the best. And I think the best model is the one that you actually use and that you use consistently and makes sense to you. So I think consistency is the best. But going out there and trying to learn from all the models and then take the best aspects of them to factor into mine. Some of the things I noticed and kind of some of the non-negotiables for me are calculating the financials on a monthly basis. So I saw some models that lacked that, and it was just a simple annual year-over-year calculation to derive their pro forma. And I think you definitely need to have a monthly capability there. You don't necessarily have to be in the weeds and looking at the monthlies all the time, but the way that the model actually totals it all together should be on a monthly basis. So that's kind of a non-negotiable. Something that's more so on the nice to have is being able to factor in a refinance into your calculations. While I don't advocate, and I've learned this kind of through others' feedback, I don't advocate actually factoring in a refi into your analysis, because investors find it to be cumbersome, a little more complex, and also a little more aggressive, because you're just making the assumption that you'll be able to refi at a certain valuation, and interest rates will be at a certain level at that time, and all of that. So you're making more assumptions. And the goal, in my opinion, for the underwriting is always to how do we make as few assumptions as possible and still arrive at a robust and conservative projection. So while I don't advocate actually baking in the refi, I think it's good to have that capability so you can see what it looks like. I mean, we'll always have an investor who says, well, what does this scenario look like? Okay, well, here's the model. I'll send it over, and it's all plugged in, and they can kind of see what that hypothetical scenario looks like. And internally, you should be able to look at that internally as well, just to see what potential exit strategies may look like. So I'd say that's a good one. And then lastly, everyone has their own way of projecting their value add. All models are almost all the same, except this one piece. They all vary substantially when it comes to actually going through the renovation, the value add, and the stabilization process, right? Some people actually kind of write out a whole rent roll, and they specify how many units per month they're going to renovate, and what's the vacancy rate, and all they get really complicated. And so the methodology that we landed on was to actually keep it very simple. And what we did is we just have a stabilization period. So if we have a certain amount of units, let's say we have 100 units, and we think that we can renovate them completely over the course of 18 months, for example, well, we just simply input 18-month stabilization period, and then the model will project on a linear basis just that renovation program, and then slowly trend the rents from the in-place to the pro forma over that 18-month period. And so that we found is just kind of the most simple, straightforward way to go.
I like that. When did you buy your first property? What year was that?
2018.
2018? Okay. So you obviously had properties in process during COVID, and so the worst part of COVID. And tell me how your model reacted to COVID, because you talked about refi, and I know there's people that were looking at, oh man, we're going to have all kinds of evictions, and but there's a moratorium in place, and then there's the idea of we're not going to make our numbers in terms of our not only the rent that we're taking in, but also our occupancy and so forth. Did you find that your model was sort of it worked really well with looking at the various scenarios that could occur during a crisis like that, or did you find that you had to adapt it, based on some of the new decisions you had to make?
Once you capitalize and acquire a property, there's not really that much you can do to change your historical underwriting, right? You had made an acquisition decision, and then you had built a business plan and raised the capital and had certain reserves in place and whatnot, and it's hard to change that after the fact. So one thing that we did learn through that experience is the formulas to calculate how much we wanted to hold in reserves for potential properties was not necessarily insufficient, but could be worth raising. It never hurts to have a little more cash on hand. So we bumped those numbers up a bit, and on a go forward basis. And then the other ways that we, moving forward during that period of time, we approached new potential opportunities. We similarly approached them as, okay, well, there's going to be some near-term issues, and so let's underwrite during that initial stabilization takeover period. Let's underwrite higher vacancy and lower collections, so higher bad debt. And what we didn't want to do is just say, hey, the sky is falling, and just make the numbers look awful, right? Because then we're never going to buy anything. So what we did instead is said, okay, well, let's just adjust the near-term operations as being, hurt. But then on the long run, we're going to be okay. In the long run, the numbers will stabilize. In the long run, approach deals looking forward.
That's good. Our audience are 50 years of age and older. They're either approaching retirement or in retirement, and they're looking at real estate as a means to either build up their own portfolio and maybe be a more active investor, but then you also have folks that are in a more passive route, that maybe they have their nest egg, they just want to get good returns. What advice would you give them to make sure that they're making the right choices in terms of selecting a company to go with in terms of their investing needs?
Yeah, I think there's a lot to that, and I think it starts with, someone would argue, and it's probably correct, to want to start with the individuals and with the company and make sure that they're in alignment there, and they trust the people, and that they're not going to run off with their money. I've heard crazy stories, and I'm sure you have as well, of sponsors or principals disappearing with the money and not being able to be reached. And so obviously you want to rule out or try to minimize those risks as much as you can by, getting to know the person and seeing that they're a reputable individual and that they pick up the phone and whatnot. So you could say it starts there, but then getting past that part, then it's about, okay, are my investment goals in alignment with their strategy, right? If you are, looking at real estate as a vehicle to produce cash flow, okay, well, you need to focus on investments that produce cash flow, durable, growing cash flow, and then kind of figure out, how you want to take other shots in your portfolio as far as appreciation or, different products and strategies. Also, taxes, of course, are a factor there as well. So making sure all that is in alignment as far as the cash flow, the strategy, the risk, the tax advantages. And then from there, I would say, even if you trust the person, I would still underwrite the deal, right? And you're going to learn a lot as a passive investor underwriting. Even if you just take their numbers at face value and plug them into your own spreadsheet, you'll learn a bunch about their assumptions and what needs to happen right for the deal to be a success in your books. So I would say those are some great steps.
Good advice. Good advice. Well, you've got this great new company that seems like it's just on fire here, doing really well. What excites you about the future, and maybe what goals do you see ahead for Lone Star Capital?
For us, we want to continue to grow the base portfolio that we built, and continue to drive successful results at the individual deal level. But kind of bigger than that, want to obviously scale that strategy, but also add on additional strategies. Something that's kind of a daunting but exciting challenge for me is going to be getting involved in the development space. That's going to be kind of our next big step, because I don't want to be an investor with a hammer in my hand, because then everything looks like a nail. I want to add on additional strategies, which would be, the development side plus the value add side, and that will allow us to be more nimble and be able to create value in different market environments. So that's kind of what I'm a little bit nervous, but looking forward to.
Oh, that's great. That's great. Well, we kind of zip by here time-wise, and sorry, I just there's so many questions that fascinating, especially on your focus on underwriting. But we have a segment now we call Wrap It Up, where I ask you a series of quick questions, and you share resources that have been of value to you. So if you're ready, we can go ahead and wrap it up.
Let's do it.
Favorite real estate book?
It'll be Investing in Real Estate Private Equity by Sean Cook.
Good one. How about favorite just general business book?
Ooh, I like Getting More by Professor Stuart Diamond. That's an awesome book about negotiation and just general kind of interaction principles.
That's great. That's great. How about a website that you use? What would you say is sort of invaluable for your business? What website do you spend the most time on?
I don't spend a ton of time on this website personally, but I think it's a valuable thing for people because it's a free resource and it's a fun tool that anyone can use, and that's justicemap.org. And that is like I said, a free website that has tons of data, and it gets very granular all across the country about median household income, population dynamics and things like that. So that's kind of my first stop. When someone gives me an address for a property, I just pull up the Justice Map and want to see kind of the color shaded regions of income.
That's great. A great resource. How about a favorite app?
Favorite app? I would say I'll give you two, and they're pretty related. They're both about time. So stay on task on your workout, and then Headspace is a meditation app. I'm sure most people know about it, so that's a good way to start your morning as well.
All right, how about a favorite quote?
Oh, I would say because my dad's in the other room and he used to tell this to me every day, I'll use this one. I'll say, do things when you can, not when you have to.
I like that. That's great. And our final question, if you lost absolutely everything, all your assets, and you had to start all over, knowing what you already know, and you only have $1,000 in cash, what would you do to relaunch your real estate investing business?
Wow, that's interesting. I would probably hang on pretty tight to that $1,000 and look for the next deal opportunity, and then use that $1,000 as travel expenses to go see the property.
Gotcha. All right. And wow, there's probably a lot of folks listening that want to hear more about you, your company, and your underwriting tools. Can you tell folks how they can do that?
Yeah, absolutely. So to get the free download of our underwriting model, you can head to our website, lscre.com. There's a link at the top to go ahead and download the model. And, the model is a great complement to the book, or vice versa. You can get the book, The Definitive Guide to Underwriting Multifamily Acquisitions. That's available Kindle and paperback on Amazon. And like I said, they're a good complement for each other, the model or the book, or you could just do one. And then if you want to get in touch with me, I'm active on LinkedIn, so feel free to shoot me a message, or you can get in touch with me directly on our website as well.
Awesome. Well, Robert, it has been great having you on. This has been a blast. There's a lot of great information. I mean, I wanted to get into all this, specifics like sensitivity analysis and stress tests and all these things that, that a lot of people might not be aware of.
Yeah, I appreciate that. And those are definitely some good topics for the next one.
Awesome. Well, we have a tradition here on the Old Dog. We are called the Old Dogs REI Network. So we have our guests always close us out with their best old hound dog howl. Now, you're familiar with Texas, and there's a lot of hound dogs in Texas. So I'm hoping that you can give us your best old howl. Are you ready for it?
I'm a little nervous, but I'm ready.
All right, let's do it.
All right, here goes. It's oh.
All right, that was a good one. Good job. All right.
Do you ever have a response, or you only let the guess go?
Yeah, no. One person tricked me into howling, but nice. I'm not going to do it again because it's not fair, for people to to hear.
Don't want to put me to shame.
Yeah, from the original Old Dog, it's just not. But you did great. You did for a young pup. You did good.
There we go.
Well, man, thank you so much for coming on, Robert. And like I said, we need to have you back so we can get into a lot of the details about some of the other, aspects of analysis and partnerships, some other areas we could have gone into. But we had such limited time. But thanks for coming on. I really appreciate it.
Yeah, my pleasure. Thanks for having me.
I also want to thank all our Old Dog listeners out there for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note everything we talked about here will be outlined in detail in our show notes on the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode entitled, look for the episode with Robert Beardsley. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.